Good morning, everybody, and welcome to this webinar from our RICS Benefits Plus partner, Tilney. The webinar today is entitled Taking Tax Year's End. Our speakers today for the webinar are Ross Anders and Rebecca Davidson. If you have any questions during the webinar, please do not hesitate to put these into the question box and the answers will be given to you by the speakers. Ross, if I can pass over to you, please.
Thank you, Danielle, and hello everyone, and good morning. Thank you for joining Tilney today as we talk about tax year end. As you can see from here, I'm a partner and chartered wealth manager at Tilney Financial Planner, and my colleague Rebecca Davidson is a director within the investment management team. The aim of today really is to talk about the tax year end, which is quickly approaching. It's not till the 5th of April. That's the last day, so there's still a couple of weeks available. And the main aim today is really to look at reliefs, allowances, and how by doing a bit of planning, structuring, setting up your investments correctly, you can put in place a strategy which maximizes returns and mitigates sort of that unnecessary risk, necessary tax that you're paying. As you see here, we'll split it into two sections. The first part, which is tax allowances, pensions, protection, is the planning and structuring side. And then I'll pass you on to my colleague, Rebecca, who will look at the investment, risk, asset allocation, our investment process. Then we'll conclude with 20 so minutes of questions. No doubt there'll be some about Mr. Putin, Russia, Ukraine, etc. So please ask away if necessary. So moving on, I think a really good place to start off with is the UK tax landscape and how that intertwines with the allowances. So this, as hopefully you can all see here, is where we are now. It's split into two sections: individual at the top, company at the bottom. And it's a relatively straightforward chart because the UK tax system isn't massively overcomplicated compared to some of our European neighbours and especially the US. As you can see on the top, you're looking at the bottom amount of tax, of course, is 0% all the way up to 45%. Company is very light, but the main one here is corporation tax. Now, there are a couple of changes on the horizon, which you would have heard about. And it looks like at this moment they are going to go through. So from April 2022, there will be an increase in national insurance. It's 1.25%. In short, it will be an NHS tax. It's providing additional capital to the NHS and social care. From a corporate perspective, however, there's a far greater change. From next April, that main rate of corporate tax, which is 19% at the moment, is set to increase to 25% for those companies generating profit of over 50,000. Now, one tax that sort of brings them both together, and it's what I'll touch upon in a bit, is dividend tax. So to incorporate that increase in NI, national insurance, dividend tax would increase on basic rate, higher rate and additional rate by 1.25%. Again, that's to come in from April 2022. But the UK tax landscape isn't looking to change that much. Unlike last year when we were sitting here, we were going through this, we were looking at wealth tax, capital gains tax, changes in income tax. Nothing's on the table, it seems, at the moment. So that's a positive. Now, that's tax. That's the UK landscape. That's the foundation for us to therefore look at reliefs and allowances. And the first area that we'll look at is what allowances are available to you at the moment and how best to use those allowances. So if we can move on to the next slide, what this slide gives you is really the 6 main allowances, exemptions and relief that are available to you. So starting at the top, in simple terms, the first £12,570 of money earnings generated is tax-free. Link this to the dividend allowance, which was introduced by George Osborne a number of years ago, which started at 5. It has fallen back slightly, but this is applicable to those who have large investment portfolios or are company directors. The first 2,000 of that dividend tax is tax-free. The next one doesn't affect us all. It affects a large portion of us, but it's the tax-free savings interest allowance, where the first £1,000 of saving interest is tax-free for basic rate taxpayers. For higher rate, it drops to 500. For additional rate, there's none. One area we'll look at today is capital gains tax. You have an allowance. Each individual in this country has an allowance of 12,300, whereby the first 12,300 of profit on investment, second property, third property is tax free. Above that, you then pay tax. And that interlinks nicely with the ISA allowance, which is the amount you can contribute into this has changed dramatically over the last 5-10 years, whereby you can transfer £20,000 into an ISA, which is completely tax-free growth and earnings within it. And the final part is the next part we'll look at is the pension allowance, starting at 2,880 for those with no income, up to 40,000. And I'll touch upon this and go into this in greater deal right now. So moving on, the first port of call will be looking at pensions, whereby I think it's fair to say that pensions aren't the most loved investment vehicle in the UK. Mainly, it's not their fault. It's predominantly down to government legislation changing so often. But if we look at this next slide, the 4 arrows are really the 4 areas that play an important role within pensions. For me, it's probably the best investment vehicle that's available. That's my personal preference because of these 4 arrows. So money that you put in to a pension, you receive tax relief on from the government. Anything when that money's in this investment vehicle, whether you invest it into an investment portfolio or property, rent, income, dividends are tax-free, and so are capital gains. The pension sits outside your estate from an IHT perspective. So when you're calculating up someone's estate, you add in houses, cash, ISAs. The pension sits outside of this. There's no tax. There's no 40% tax on this. And finally, tax-free lump sum. 25% you can draw tax-free at age 55. This is set to increase to 57 at 2028. But it's a great benefit, and it's also a great planning opportunity. You do not have to take this 25% all in one go. A lot of planning that I do with clients is phasing this, whether it's over 5 years or 10 years. When you first call upon your pension, it's often the case that you are spending more of that time, whether it's in your late 50s, early 60s, mid 60s. You are spending more as you are fit and able to do so. Therefore, what you want to do is potentially draw out an element of this lump sum, which is tax-free, therefore saving or preserving the rest of it that could be taxable in the future. It's little steps like this that can save plenty of money over the long term. Now, the important part with these pensions is really threefold, and the first port of call is what type of pension you have. So if you're sitting down this evening and you go, oh, I'll just look at my pension, look at what type of pension it is, because a number of older style pensions do not benefit from these 4 arrows. The second part is looking at allowances. How much have you put in this year? How much have you put into the 3 previous years? And that is very, very key, and I'll explain why in a minute. The third part, what you're invested in. Guarantee most of the time when I review pensions, they're in what they call the default fund. And that default fund is great to some extent, but it could cause issues down the line. It's not aligned to your objective. So if the return profile underperforms what you need, it could leave a shortfall in the future. And this is something Rebecca, my colleague, will go on to talk about in a wee while. But also our sister company, Best Invest, provides something called Spot the Dog, which is a great little brochure which identifies those funds which have underperformed over the last 3 and 5 years consistently. It allows retail investors, or allows yourself as people that hold pensions, to look at funds that really aren't that suitable at this moment. So moving on to the next slide is focusing really on arrow 1, contributions. It's a simple chart, this. It's looking at what I make £100 contribution into my pension. What does that really mean? Well, for one, you don't make £100. So if you personally transfer money in and you want it to be £100, you actually only make £80, because as soon as that money goes into your pension, the government give you 20%. It's called basic rate tax relief. For a higher rate, again, £80 goes in, the government then give you 20, and on your tax return at the end of every year, you apply for a higher rate tax relief and therefore gain a further 20% on top. The same for additional tax return, 20%, 25%. So you gain an additional 25%. A little quirk within our tax system is those earning between £100,000 and £125,000 a year. Now, for every £2 that you earn above 100,000 up to 125, you lose 1%, £1 of your personal allowance. So that effectively means that the tax you pay between that bracket is 60%. So, as you can guess, if you make a pension contribution and your earnings are that lot, it brings down your taxable earnings, and therefore your effective pension contribution rate is around about the 60% mark. So really important to sort of take this into consideration. The benefits, therefore, of just putting in that £80 and being given an additional 20% on top. Now, if we then move on to contributions, because you might sit there and say, well, I'll just put as much as possible into my pension. That is not the case. And the next slide explains that into further detail. Contributions can almost be split into two sections here. There's a limit on how much you can put in a year, and there's also a limit on how much you can have in your lifetime within a pension. So the annual allowance for an individual is either 3,600 or maximum of their relevant earnings up to 40,000. What that means, if you have no earnings, the maximum you can put into your pension is 3,600 gross. Or if we're looking on that net position again, you put in 2,880 and it gets grossed up by the government to 3,600. Now, if you're a higher earner, the maximum you can put in any 1 year is 40,000. And say if you're earning about 30,000, the maximum you can put in is your maximum earnings, so it's 30,000. But one important consideration here is if you're an additional rate taxpayer or a substantial earner, where you're earning more than £312,000 a year, the maximum you can put in is £4,000. And what the government have done is said for those that earn more than £240,000, you are tapered again up to 312,000. So for every £2 again, you lose £1 of that annual allowance that you can put into your pension. And if you have been in that position, it's important that you address this quickly because of the potential tax charge payable. Now, if you're thinking, oh, well, I've done 40,000 here, but I forgot to do previous years, that's not a problem. You can actually look back 3 of the previous tax years and carry forward or mop up any unused allowance. So in theory, you could, if you had the earnings, put £160,000 into your pension in 1 year. And of course, that's the gross amount, so you need to net that back. Now, lifetime allowance. Well, this is the maximum you can have within your pension without being penalised. It doesn't mean that you can't accrue more of it, and you can. But the lifetime allowance at the moment is 1.073 million, and that's in place now till 2026. So when you draw benefits, you're assessed against this amount. If you're above this amount, and you incorrectly take out too much and don't plan it or don't put in place a strategy, you could pay tax up to 55%. So it's so important that you plan for this. And looking at contributions and lifetime allowance as one, what you're looking at is when you're contributing is how much can I put in? How much can I contribute? Can I carry forward anything? Am I approaching the lifetime allowance? And what are the options available to me? Now, a question that I'm probably asked more than any other question within this field is, how much do I need to retire? So this leads us into the next slide nicely, whereby it's just not that simple because everyone is unique, everyone is subjective, everyone's individual. To me, it's all about how much you spend. If you spend a lot in retirement, you need, of course, a far bigger pot. This is an example that we've used with clients. We use it pretty much with every client. It's called cash flow financial forecasting. The aim of this is to forecast forward based on assumptions and future contributions, what that magic number needs to be. This one here, an example, spending £33,000 a year net. Remember, that's net. So that's about 38,000 you're having to draw out your pension because you're paying about 5,000 towards tax and then 33,000 is the income. And what this shows is that you're spending too much. That 500,000 or £500,000 pot by age 80 is exhausted. So by doing cash flow forecasting earlier, you can work out what your spending patterns are likely to be in the future. Of course, it's still estimations or guesstimations, but you work out what that's going to be, and then you go, right, either in retirement I spend less, or actually I add more, I create more, add more contributions. And if you're restricted to make contributions, you look at ISAs. And if you're restricted, if you've done your ISAs, you look at other investment vehicles, you look at rental property. So when you turn 60, 65, whenever you want to retire, I call it financial independence. When you hit that magical age, you have a pot of different assets, including in your pension, where you can draw upon that generate a tax efficient income for you to maintain the standard of living in retirement. Now, this leads us into sort of actions to consider for your pensions. And the way I split this next slide is into two-way, immediate and long-term. Where you are now, what can you quickly do? Well, if you're going to receive 40, 45% or even 60% tax relief, try and take advantage of it if you can. Look at surplus cash. What's sitting in cash? Interest rates are low at the moment. Inflation's high. What can you maybe move that you don't need into your pension? If you're married, you get spousal exemption. You can consider making pension contributions on behalf of a spouse that maybe doesn't have earnings, therefore you utilize their unused allowance. And also, probably the most important is death benefits. Look at your employer scheme, your money purchase scheme. Yes, you might have a SIP. What happens to you if you die? Who receives this pot? It's vital that this is up to date, so you know it's getting passed to the correct person. Longer term, take advantage of employer pension contributions. Take advantage of the tax relief available. If you're a director, if you own your own firm, if you make pension contributions, it's money transferred out of the business before tax. So you can extract money out of your business in a tax efficient way. If you have older plans, review them. Consolidate them if needs be. Move them into a vehicle that is aligned to what you need. And last but not least is state pension. Often forgotten, but if you have an up-to-date state pension, it's a valuable additional guaranteed source of income, guaranteed at the moment, I must say, in the future, that could meet that shortfall that you have. Very simple, go onto the government website, request a forecast, it's usually instantaneous. So that's pensions. The next slide we'll be looking at, the next area is capital gains tax, an area that was heavily covered by the media this time last year. When they were looking at how do we pay back COVID, capital gains tax was thought of, and it was the rumours were that this was going to increase. The reason why is because it's out of sync with income tax. It's actually quite a favourable tax, and if you look on the next slide, you will see why. So from top to bottom, you have 10% and 20%, and from left to right, you have 28% and 18%. 10%, 20%, top to bottom, is non-pension investment assets. Therefore, any tax payable on those assets, if you're a basic rate taxpayer, it's 10%. If you're a higher or additional rate taxpayer, it's 20%. If you have second property, additional properties, the gain is taxed at a slightly higher rate, and that's 18% for basic rate, 28% at higher and additional rate. And this is added on to your earned income during that specific tax year when you sell that asset. Now, as I mentioned before, there is an exemption. It's 12,300 each individual. So if you buy a share and it increases by £10,000 or £20,000, the first 12,300 is tax-free. The next amount is potentially taxable at your marginal rate of tax. Now that's per individual. People that are married, civil partnerships, you get spousal exemption. So therefore, you can actually team up and have 24,600, which can further mitigate that. Now, if we move on again to the next slide, and we look at areas to consider regarding capital gains tax, the transfer of assets to spouses is very key. If you have a large gain within an asset, and you already are using your capital gains tax allowance, you can transfer that to your spouse, who then can therefore use their capital gains tax allowance. That is permitted. You are able to do that. Bed and ISA, technical word within this industry. All you are doing is utilizing or selling an asset that's in a taxable environment. You're bedding that gain and transferring that gain into an ISA and then using that 20,000. You can crystallize losses to offset gains. If you have a large gain and you have a loss that you don't think will recover, you sell that and net that gain off. You can defer gains, business sale into tax efficient investments such as EISs, but be very wary that these are high risk investments. You're investing into almost startup companies that are right at the beginning of their life cycle. But if you have a large gain, you sell that business, you could in theory roll that over into an EIS, and there's other tax benefits by doing that, but please, advice should be sought if you ever need to do this. Crystallize gains sooner rather than later. So use it or lose it. If you don't use your capital gains tax in this tax year, it does not roll over. It's not like the carry forward of the pensions. So that's the sort of areas we've looked at: pensions, ISAs, capital gains tax. The last little area I want to just call upon is protection. And that moves us on to the next couple of slides, whereby we often spend our life insuring. You have to insure your car, TVs, contents, home, phones, the lot. Everything materialistic is usually insured, but often people always forget about themselves. If you're an employee, you'll say, or own your business, you might take protection or use the benefits you already have. That's not often enough. With your employer, it's usually the minimum amount that you receive, and it's often death in service. What we often look at is these three key areas: income protection, life cover, critical illness. For me personally, this is very, very important, because it's asking those questions of, especially given everything that's happened over the last 2 years, is what happens to me or my family in the worst case scenario? I lose my job, myself or my partner die, and I've got a mortgage and I've got children. Or critical illness, if I'm diagnosed with a critical illness, cancer. It's important that we look at these, and most people go, "Oh, it's just too expensive. I'm not going to pay that." Well, I did a little calculation earlier this morning. So based on a 45-year-old, relatively good health, for just £75, I say just, but £75 a month. So if you have that surplus income, you can put in place a policy which, if something was to happen to you and you couldn't work, after 3 months, you would receive £3,000 net, tax-free. If something was to happen to you, you would die, you'd receive 80,000 life insurance payable and 80,000 critical illness. So if you do have surplus, it's working out, what surplus am I left with every month? What's my shortfall? What happens if something was to happen to me? What's the worst case scenario? Can I afford to insure against that or protect me and my family against that? That's protection. So as I say, look beyond your employment benefits. Find out what your employment benefits are first and foremost. Is there still a shortfall after? If there is, do I have surplus income? And if I do, can I put in place a protection policy that just provides that just additional level of security? Now, I thought quite a bit of information to go through today, and I've got 25 minutes, but we've left you with a little checklist on the next slide, which, I mean, you might not need to tick all these, but it's just little things like just remembering, for one, tax rules can change. But at the moment, as I mentioned before, the UK tax landscape, these are what they are, but they could change in the future. Look at making pension contributions if you can do. Look at utilising the CGT allowance, capital gains tax allowance, if you can do. Inheritance tax might be applicable to some of you. ISAs are probably more applicable to you all, utilising them. If you've maximised pensions, you've maximised ISAs, and you're looking for other sort of avenues of maybe mitigating some of that tax payable, look at tax efficient investments. There are greater risk attached to these, so definitely seek advice regarding them, but they're great opportunities to either offset income tax or offset capital gains tax. And use the interspousal or transfers. Use those allowance to each. Utilise both the ISA allowances you have. Utilise both your pension allowances you have. and think of the bigger picture before making these decisions. It's simple, just plan ahead, put in place a plan. If you're a business owner, you plan for the business. But often you forget about planning for yourself. So put in place that plan, then get all the structures in place so it's tax efficient now and onwards. And then finally, as I hand over to my colleague Rebecca, what she's going to talk about is the underlying investments, maximizing those risk return rewards over the long term. So thank you, Rebecca. I'll leave it in your hands.
Good morning, everyone, and thank you for joining us. So if we move to the first investment slide. So I'm an investment director within London, and I will be just going through a couple of things that I think you should actively think about before investing. And the starting point is really to discuss what is putting off people when it comes to investing, because as Brits, just 12% of households actively invest, despite the fact that many recognise that they would be better placed to achieve their goal if they did so. But the funny thing is as households, we typically allocate capital every day, and this might be small ISAs, cash in a bank account, which in itself is an investment decision, or a mandatory company pension. But I can understand why investing can often feel very unfamiliar and opaque. And that's not to mention that actually the fund industry itself is massively oversupplied with really mediocre products. So there's roughly 30,000 UCITS funds that I could invest for my clients, and roughly 2/3 of them fail to beat their benchmark. So today I just want to go through some of the factors that I think are really key to consider when approaching an investment, and hopefully they'll be applicable to you irrespective of your experience of capital markets. So on this next slide, where do we begin? Well, the first activity I undertake with all of my clients is to understand their risk tolerance. And your risk tolerance and your risk profile is the foundation of every decision you make thereafter. And your risk profile sits right in the middle of your ability to take risk, your willingness to take risk, and your need to take risk. And because of this, I'll often see clients with identical financial characteristics. They may be the same age, they may have the same objective, but they'll have very different portfolio outputs because of this. So starting with the ability to take risk, this takes into account a number of factors, including your income, liabilities you may have, dependents like children or elderly parents, overall asset base, age, investment horizon, and so on. So here what we're really trying to work out is what risk can you afford to take and for how long. The next factor is your willingness to take risk, and that's really your willingness to endure volatility. Volatility in itself is not necessarily a bad thing. It's the fee we pay for higher expected returns, but there are effectively two ways of permanent loss of capital, which for me is the ultimate risk. And the first one is that you invest in poor quality investments that ultimately go bust. And the second is that the market falls, as we saw 30% falls in the pandemic. One panics and one liquidates an investment, crystallizing a loss during a period of quotational movement. So I think it's really important before you invest to understand your own personal breaking point for seeing paper losses in a portfolio. Last but not least, we come to the need to take risk. And in reality, most individuals don't have a high need to take risk other than to achieve a return in excess of inflation to ensure that their purchasing power is maintained over a period of time. There are exceptions though, and this includes any sort of client that has expenditure like care home needs, school fees, or charities and foundations that have a known liability over a 12-month period. So on the next slide, if we can move to the next slide, we understand your profile, and this is now really where the fun begins. So the first thing I talk through every client after we've established a risk profile is really the function of investing. Why do we bother to do it at all? And I think a lot of clients initially think about outperforming the FTSE or the S&P, a tracker or a peer group. But the reality is most clients need to preserve and grow the real value of their capital over time so they can buy more goods and services in the future. And as simple and as obvious as that sounds, you'd be surprised how often people simply don't think that through and what they need to achieve if that's their goals. So starting with the top left-hand box, preserve. The aim is to avoid permanent loss of capital. And there's two ways that we can help preserve a portfolio. The first one, if we move to the next slide, is to ensure that portfolios are appropriately diversified across asset classes. Now, how diversified a portfolio should be is a reflection on your ability to take risk. However, broadly speaking, equities, stocks and shares will be the core driver of returns in portfolios. But also we typically include low risk investments like bonds, whether they be government, corporates, gold bullion, absolute return funds, property, a selection. And as you can see in this chart, in any given 12-month period, it's really hard to predict in advance what will be your best and your worst performers. So it's key to have an appropriate spread of assets. And even if you believe that equities will be the core driver of return, if we have falls of 30% as we did during the pandemics, it's really important that if you have the need to take distributions, to take an income, you have lower risk investments to dampen down volatility, to allow you to remit to your bank account any sort of short-term spending or expenditure, and also to allow you to rebalance the portfolio to take advantage of any short-term opportunities. Now, moving to the next slide, at Tilney, we use a proprietary software to drive optimal asset allocations for clients. And this looks at both of their target returns and their tolerance for loss. But even within asset classes, not all investments are equal. And on the next slide, we show how we can further control that beyond just asset allocation. And this is now looking at the stock selection within those asset classes. And this slide here shows an example looking at the impact of the financial crisis on companies' earnings during the period of 2008 to 2010. And we know that in every market cycle, there are certain businesses that, due to their characteristics, their financial leverage or their operational leverage, are very sensitive to market turns. And a great example of this is looking at either the banking sector, materials, energy. During this period, you could look at some of the best energy and mining companies out there. However, if the underlying commodity that you are selling, be that oil or copper, falls by 50%, you could be one of the best management teams out there, your revenues are going to suffer. And so our starting point for making sure that we preserve capital is ensuring that we're investing in sectors or businesses that are very consistent through time. So to give you an opposite example, they're shown by the blue bars, so healthcare, consumer staples, technology are great examples of resilient sectors. And we can look at a healthcare business like Novo Nordisk selling insulin to diabetic users. And that product was typically very highly in demand, irrespective of COVID. We can look at Microsoft, which sells their products to over 1 billion daily users. And irrespective of what's going on with Russia and Ukraine, they used to sell the boxes every couple of years, and now we're all signed up to annual subscription-based models. They're able to generate revenues on a very consistent basis. And if we have that consistency, that's a really good starting point for, as an investor, to base your assumptions on. So moving on to the second box, grow. On the top right-hand side, we typically view the stocks and share component of the portfolio as the long-term driver, and this is the area that does the heavy lifting for us. If we go on, I think we've gone the wrong way on the slides. One more. Fantastic. And the equity does the heavy lifting for us, but equities are also one of the most volatile asset classes that we can buy. And so how should we view expected returns in the face of such uncertainty? And I get this question, what is the outlook for equities? Are they going to make money? Are they overly expensive as of today? And on a simplified basis, the way that we estimate our long-term returns is we look at the free cash flow yield that a company will generate, and we look at the growth in that free cash flow yield. Now, on this chart, we've shown Fundsmith, and as a disclaimer, there's a big disclaimer at the bottom. This is not an investment recommendation, but we've used it because it's one of the largest and most successful funds in the UK, and stands at 26 billion. It's grown significantly over the last 10 years. But the story for looking at how Fundsmith has achieved this is when the fund managers started the fund back in 2010, they found effectively 30 companies that had a yield, and you can see, of 6.4%, and they had a historic cash flow growth of around 11.3. So give or take, because we have to account for multiple expansion, stocks getting more and less expensive, you would have expected around 17% over the next 10 years, because your free cash flow and the growth in that free cash flow is the dominant determinant of what your long-term return should be. And so what we've charted is the next 10 years, and you can see the pink line shows 17.7% annualized, the gold bar shows you the return of Fundsmith, and the black line shows you the MSCI World. And whilst it's not identical, they pretty much achieved exactly what you'd expected from the start. Now, I've got to be very realistic with you. When we look at the same companies that the fund owns today, are they generating 17% for us? When we look at those underlying factors, the reality is no. The free cash flow yield is a lot closer to around 3, and the growth is expected around 8. But if you look at those two numbers together, if you can get high single digits, low double digit returns for buying very high quality businesses and very consistent generators, that's still a very attractive return relative to bonds and cash, given that you don't overpay for those qualities. So on the next slide, moving off growth and into real returns, shown in the bottom right hand side. Before you can celebrate generating a real return, there's a number of costs you need to account for, and these include management fees, dealing costs, and taxation, but very importantly, inflation. And that's why I mentioned by having cash sitting in the bank, you are actually making an active investment decision. And if we go on to the next slide, we can see that even modest levels of inflation can be harmful. What's interesting is I did this presentation about a year ago, and I was looking over my notes. And last time I sat here discussing investments and inflation in the UK was at just 1.1%. As it stands today, inflation in the UK is 5%. They expect this to trend higher to 7% by April, the highest in 30 years. And I appreciate we have a very international crowd today. So if you're sitting in US dollars, that inflation number as of today is around 7.5%, so the highest in 40 years. And the reality is that this is probably one of the most insidious threats to the capital as you sit there. I often find and sit down with clients who say to me, I can't possibly tolerate a fall of my portfolio more than 15%, but they'll happily sit in cash for over 5 years. And if you have inflation at 5% for 5 years, you'll lose roughly 25% of your capital. So admittedly, inflation over the last 10 years has been very low, but asset price inflation hasn't. So if you were to measure your wealth in fine wine or vintage cars, or even stocks and bonds, you'll find that cash has materially lost its spending power. And it's very, very key to consider the impact of inflation on your wealth over the long term. And last, but by no means least, is time, shown in the bottom left-hand side there. So over any short-term time horizon, the majority of returns that we generate in the stock market is driven by sentiment. And if we go to the next slide, you can see just how significant that is. So over 1 year, roughly 62% of returns are explained by multiple expansion, and that's normally driven by emotional sentiment factors. However, if we extend your time horizon to 10 years, you can see that significantly the majority of your return, roughly 86%, is generated by cash flow. Like, did your company grow in value over that period of time? And the reality is that the short-term emotional factor and sentiment is very hard to predict. And if you do predict it, you have to make consistent calls over the long-term time horizon. However, if you have the patience to look over a longer time horizon, finding exceptional companies with good underlying fundamentals and earnings and profit profiles is a lot easier to do. But you just have to have the patience to extend your time horizon to do so. And I think that that's a big, big factor for us. That's almost a competitive advantage you can have against the wider market that has a very short-term time horizon, less than 12 months. And if we go to the next slide, the reason why taking a longer time horizon opposed to try to timing the market is so important is because if we look over the last 30 years, just 0.4% of trading days have accounted for almost 90% of stock market returns. And if you miss them by trying to trade in and out of the market and calling market cycles, it can be incredibly costly. So on the slide below, on the left-hand side, this is just using the UK market, but it's applicable to most stock markets. You can see on a cumulative basis, if you bought the stock market and held between 1998 and 2021, you'd make a return of 161%. But if you miss just the best 30 days, your total return actually was a negative return, down 44%. It's a very significant divergence between the two. So fundamentally, we believe that we're investing for the long term. We're not trying to speculate over short-term time horizons. And if you have patience, that's a key competitive advantage for you. And on that note, I think we are now opening up for questions.
Thank you very much indeed, Rebecca, for your presentation, as well as Ross. Thank you. We have had some questions come in from the audience. Can I remind the audience, if you would like any questions, please do pop them in the question box and I'll pop them to the speakers. So first of all, Ross, if I am an additional or higher rate taxpayer, what is the most important thing for me to consider pre-tax year end from a planning perspective if I have money to invest?
Oh, good question. I would, given there's only what 6 or 7 weeks left, you don't have much time. So whatever you do it relatively quickly, because systems with providers, etc., aren't necessarily the quickest. But first port of call for me is if you're sitting on a surplus cash or income, etc., that gradually builds up, I'd always firstly just have a quick question of what's the purpose of this money, what's it doing? As Rebecca's pointed out, if you're leaving it in cash, the only reasons why I would keep cash at the moment is an emergency fund. Interest rates have gone up from the Bank of England. They haven't gone up on cash rates yet. There's always a delay there, and with inflation at 5.5%, it's quite a nervous time for people with large cash balances. So leaving it in cash, if it's excess cash, then there's not probably a good investment strategy. So what you want to look at first is potentially the right structure, as I mentioned. Is it better to put it in pensions, ISAs? My first port of call is usually a pension if you can. If you're a higher earner, take that tax relief. It's there. Crystallize it. There's not many things the government give you in life, but tax relief is one of them. If you've maxed out on pensions, look at ISAs. If you've maxed out on ISAs, look at sort of the tax efficient investing over the long time. But first of all, and then once it's structured, don't just leave it in there. Really delve deep. Ask questions of the investment managers that manage your money. So surplus, if it's excess above emergency funds, utilize pensions, maximize those tax relief ISAs, and then other tax efficient investing if you need to be.
Thank you very much. Rebecca, we've received a question for you, which is very topical just now. Should we be concerned about what's happening in Ukraine and Russia at the moment?
Yeah, I expected a question or two on this. Yeah, it's concerning to see the escalations in Russia and Ukraine. The UK is suggesting we introduce sanctions, and Ukraine's called to halt the Nord Stream 2 pipeline, which could have an impact on energy prices. We've seen energy increase to $100, which is the highest we've seen it I think it's 7 years. So it has been a significant impact on the market, on energy commodity pricing, and that in itself could impact all of the European area, given that Russia accounts for 1 in 10 barrels of oil. But I think the reality is that every given period there is something on the top of the horizon. It could be a social or economic political development. It could be in the US with their budget ceilings. In the UK, we've had it with Brexit. Before Brexit was Grexit. And I think that what you have to look through as an investor is there will always be macro concerns and issues. You have to look at the underlying companies that you buy and have an evaluation on, will it impact their effective business model? And I gave an example of Microsoft earlier, but just to use that, will escalations in Russia and Ukraine materially impact their sales and their revenues and their products they sell? The reality is probably not. When we look at our underlying companies, we have no businesses listed there regionally. We have very few revenues derived from the region. So it is concerning to stock markets. It can cause volatility because it drives down that sentiment, which is a big determinant of returns over a short period of time. But if you have the patience and you have the ability to look through volatility on a 3 to 5 year time horizon, you really should still be able to find exceptional companies and opportunities that won't be materially impacted by what we're seeing in that region.
Thank you very much, Rebecca. Ross, one other question for you. Considering personal protection, how do you get to the right sum assured?
Look at employer benefits. After that, look at what does that leave you? What happens if something happens to you? It's what I mentioned before in the sort of the seminar. It's what ifs. If that's the case, work out what that shortfall is. Personal situation would help. I've got a mortgage. If something happens to me, that liability stays around, and it would fall upon my wife and my children. So I need to ensure that that liability is matched. I take out a protection policy on top of what I have from my employer. So I have death and benefits, death and service here, and I have income protection. I don't have critical illness. And for me, getting an illness like that could cause all sort of headaches, trauma. So work out what you have from the employer, what if something else happened to you, and then lastly, what that shortfall is, and then just ask questions. How much does it cost? And work out. You don't have to take out the maximum amount. Don't over-insure yourself, but just make sure the minimum shortfall is covered.
And one other for you, Ross. How do I make sure I have enough in my pension for when I retire?
How do I make sure that I have enough? Good question. It again goes back to what I said before. It's just working out what that magic number needs to be, what age you are, planning towards the future. If you think that it needs to be £1 million, why does it need to be £1 million? Work out what your spending would be after all your liabilities, because hopefully once you've achieved financial independence, that liability aspect of mortgage is gone. What does that look like? You can then multiply it forward. And I would do all of that. You then structure it. And what Rebecca would therefore do is say, right, let's find the right investment profile that matches that 4 or 5% that you need. And it's all about matching it. It's all about need, not necessarily about what you want.
Okay, thank you very much. And for Rebecca, how long do I need to tie my money up to invest my capital? Sorry.
Yeah, absolutely. I think the reality is that we typically say to clients that you shouldn't really look to invest in the stock market unless you have a time horizon minimum 3 years. The reason why is effectively looking historically back at how long it would have taken you to recuperate money if you invested on day one and the stock market fell immediately after you started investing. That's in sterling. I'm conscious that we have both sterling and potentially US dollar clients on the portfolio. In US dollars, it's actually slightly longer. If we look back over the last 30 years, the worst periods of equity market moves were over the last 30 years with the tech bubble between 2000 and 2004 and the financial crisis. So they were both roughly 4 and 4.5 years for the moment the market fell to recuperate your money if you were invested in the stock market as a whole. So I think that's why we typically say around that 3 to 4 year time horizon is the minimum we'd recommend people invest in stocks and shares. But the reality is it does matter what your risk profile is, because you can have different levels of risk, you have different volatility and probably variability of outcomes. So it depends on what you I think 3 years is probably the starting point, but it really depends on your risk profile. And do you need 100% of your capital? What's your other circumstances? Would you have income to supplement your need if the stock market did fall? There's a lot of factors you need to consider.
Great, thank you. And our next question, I'm a graduate. If I have money to pay off my student loan or invest, which one would you recommend?
Thank you for that. It's a Martin Lewis special. Unfortunately, if you're in the old sort of style, I would say leave it. Don't pay it off. Martin Lewis had the belief that it's a tax. It's not necessarily a debt. I think psychologically that's not the case, because actually sometimes when you look at it coming off your paycheck, yes, it is almost like a tax, but doesn't necessarily mean that it is, and it still psychologically is reducing your net income. The way it is look what the interest is on it and how long it's going to take you to pay that back. Then if you're going to invest it, potentially over a long period of time, you'd need to return that at least matches that net, if not more. That's the way to look at that. There is, if you go onto our website, and go through some of the guides there is one specifically aimed at that question of whether I should pay off the loan or invest it. It provides a great answer from one of our younger advisors that was in that position. So I'd advise to go and find that if you can, or just ask and we can send it through.
And another one for you, Ross. Can you advise the benefits of SIPP pension and the cost to set up? And do Tilney set up these pensions?
SIPs, we do.
SIPs,
we don't personally have we don't have a SIP ourselves. We use a number of providers which come through a panel which go through our due diligence purpose. SIPs are great. They can be very, very good. If you put it in comparison, your employer scheme, let's look at that. It's very light touch. Often all you're allowed to invest into will be a limited number of funds. Now they're expanding those funds, but it is predominantly just listed. It is restricted to that. If you set up a SIP, and actually from our retail perspective, we do have what we call Best Invest SIP, and that's from our sister group. You can set up there if that's something you want to do it yourself. But otherwise, where I advise on SIPs will be with investment portfolios, but also commercial property. That is often the benefit of having a SIP. You can purchase commercial property within a SIP, provides that an additional exposure to investments that a number of people want to explore. Costs of setting up, they are more expensive than your standard personal pension because you're allowed to do that. If it's a commercial SIP, it can be anywhere up to sort of £800, £900 a year, annualized. SIPs that we would use can range between sort of £100 and £400 a year, and what that is simply administration cost. So they will do all the tax relief if you're adding money into the benefits, everything like that. You're paying for administration.
Thank you. One for Rebecca. Rebecca, do you think that inflation will remain higher for longer?
Well, potentially with what's going on in Russia, there's the potential for it. But I would say that I think the big question that we have been asked a lot is inflation structural now, or is it just transitory? Is it just passing through? And there's good reason for both. I think on the transitory level, COVID contributed significantly. It had an impact on both the supply chains and the inventory of stock. And now we're seeing an increase in demand, even though those supply chains are not necessarily back to normal. And then we have a rebound in the price of energy from the lows that we saw in 2020. So all of these factors combined to inflation, I think we could have inflation around for significantly longer. And I think that when we look at the portfolio, the key elements that we're looking at within the underlying stocks and companies that we're buying is, what are the company's ability to pass on high costs to the consumer? What do they have as an economic moat, be it a brand or intellectual property, some sort of networking distribution, which means that they can pass on those higher costs to the consumer so it doesn't eat into their profitability and impact our clients' outcomes. So I think we could have inflation for a little while yet. I don't think it's going to go away. It may not be as structurally as high as the 7% that we're expecting to see in April, but it can. I wouldn't be surprised to see it higher than it's been over the last 10 years for some time.
Thank you. Another one for you, Ross. Can you elaborate on the range of other tax relief efficient investment options available beyond ISAs, please?
Yeah, there's a few. My employers and businesses always sway on the side of caution here, because once your standard vanilla saving vehicles, well, there's four really. You have cash, you have pensions, you have ISAs, and then you have something called a general investment account. It's similar to an ISA or a pension, but you don't have the tax benefits for that. These are the four areas you should look at first. After that, based on circumstances, there might be other investment vehicles that are more appropriate to those people that can accept a high level of risk or have specific IHT mitigation strategies that they want to implement, or income tax strategies. These are venture capital trusts, EISs, SEISs, which are even smaller, seed enterprise investment schemes, AIM portfolios, business property relief. These are very unique and completely based on that client's or that prospect or that individual's circumstances at that point in time, and you have to seek a specific advice regarding it because the risks involved are huge. The potential upside, tax savings can be fantastic, but it is a case-by-case basis. It might be suitable, it might not. Now, for those high earners where pensions are no longer viable, ISAs are easily maxed out between them and the potential spouse or partner. And general investment counts the sufficient amount in that to utilize your capital gains tax allowance. These could come into play where I work with a lot of either business owners or executives. Is the idea that they might have large income tax bills or large capital gains tax bills. These types of tax efficient investment vehicles can mitigate those taxes. You do read about some horror stories in the press, specifically the Sunday Times. So you've got to be very wary, and you've got to seek proper advice on how those types of investment vehicles have come into fruition. At Tilney, we're one of the rare companies that have a dedicated tax efficient investment panel, whereby we have a number of employees who will ensure that the investments that come onto our panel have met the criteria from a due diligence perspective, and that is very important. So I hope that's answered that. Again, more information on our website, and my details are here. So if you ever want to find out more about those types of structures, please just drop me an email or reach out to Tilney.
Thank you. Just for the audience, we have less than 5 minutes if anyone would like to pose a question. Another one for you, Ross. If I am set to receive a lump sum of cash and will be looking to put it towards buying a house within the next 5 years, what is the best option for me? As you said, keeping in the bank isn't the best option, but investing requires a long-term plan.
I think this is maybe one for both of us here. So what I would touch upon first, how are you receiving that lump sum? Is it through a defined benefit scheme, i.e. the old school employer final salary schemes? If that's the case, then you might be automatically receiving it. If it's not, do you need this lump sum at this point? Can you keep it invested within the pension? And secondly, if that is the case, 5 years, although deemed as a shorter time horizon, there is still scope to go through a cyclical environment. Then, as you say, if you leave it in cash, what you are guaranteeing is inflation risk. So again, it's case by case basis. But if you do have that lump sum, you've got right for the next 5 years, this is what I need to achieve. Therefore, we would often sometimes look to construct a type of portfolio, investment portfolio, that would generate a level of return that is potentially inflation +1, etc. And Rebecca, you probably go into a bit more detail with those sort of situations.
Yeah, absolutely. It's quite similar to the question of what the minimum time horizon should be. I always feel that if you have a known liability, you should account for that and take risk off the table. But within the next 5 years, that's a big difference if we're talking about in the next 18 months or if we're talking about something 3 or 4 years out. And I think if it's a case of if it was in the next 18 months that you're looking for it, I just simply wouldn't take the risk. However, if it's a case that you're thinking this purchase might be 3, 4 or up to the 5-year mark out, there might be a level of risk that would be more appropriate for you to protect against inflation, but not expose you to maximum volatility of the equity markets.
Thank you very much. I have another question from Ross.
One more, Danielle, if you, yeah.
Yeah. This will be the last question. I have a public sector pension. Does my employer's pension scheme count towards the pension 1 million allowance?
Grand scheme of things, yes. So the lifetime allowance is both final salary, and that's the DB, and personal. If you are approaching the £1 million allowance, what I would recommend is speaking to someone or having a quick chat about how best to approach this. I work with clients that have substantially exceeded their lifetime allowance, and what we put in place is a strategy to mitigate that excess charge where best possible. Now, The easiest way, if you have a public sector pension, the way you can sort of come to that calculation is the amount of income and times it by 20. What does that lump sum give you? If you have that employer pension scheme, add it on top. And the simple way of doing it, when you come to take benefits, they take all your pensions that you have every single place, old, new, and just add them all up. And that is where you are against your lifetime allowance.
Thank you very much indeed. Well, I'm afraid we're now at the top of the hour. I'd like to thank Ross and Rebecca for the session today. You'll be receiving an email within the hour which will give you links to various Tilney information, and the recording will be available on the website next week. If you require the presentation, I'll ask you to contact Tilney direct. Thank you once again for the session today, and I hope everyone has a lovely day. Thank you.
Thank you.